Just when everyone seems to be in a panic about gas and oil prices, crude may be in a position to complete a high lasting several months, followed by a 20 to 30% decline or more, just contrary to what everybody is fearful of. Plus, we'll do a follow-up on the S&P. I'm Robert Miner with Dynamic Traders Group, and this is our weekly trading video where I teach you a specific trade strategy and a current market position. It's a brief version of the much more extensive videos we provide our DT Report subscribers. Now, even if you don't trade crude or the S&P, what you learned today, you can also apply to any market in any time frame, so pay attention. And be sure to stick around to the end of the video where I'll tell you how to receive our just published 12-page dollar, euro, and Bitcoin big picture report, as well as the recently published 17-page big picture report for the stock indexes. And while you're watching, feel free to comment below about this video and what aspects of practical trade strategies you'd like to learn more about. Okay, let's get started. Do a deep dive into the position of crude oil. So this is the crude weekly data, and it's the April contract of the futures. So let's take a look at this briefly. There's some really important information on this chart. Number one, let's take a look down along the bottom here. This is our DT oscillator momentum cycle indicator. It's a really handy indicator. It's quite useful and reliable to help us identify cycle highs and lows, at least in momentum. And then we can see if the price relationships are also going to make reversals, which is usually the case within a couple bars of the momentum reversals. And this is the last couple of years worth of data, and typically each time weekly momentum made a bear reversal is that we had a significant top. That is a top that lasted at least a few weeks. So the market would be sideways to down 4 to 6 weeks around the time when they made the momentum bear reversal. So this last week is the first time since last October that the weekly momentum made a bear reversal. That's significant. It was also, as you know, a really wide range. We call this a bear reversal week because it made a new high and then closed significantly below the close of the prior week. Let's take a look at the pattern because this is textbook Elliott Wave speculative blow-off top. So we've been anticipating long before the conflict in Europe and with Russia that the crude was in the final stages of a very significant bull trend begun back in April of 2020. And when it spiked up these last 3 weeks, this is what you call a speculative panic blow-off top, and it just happened to be, in Elliott Wave terms, a wave 5 of 5. That's really significant because it indicates that more than likely the bull trend from almost 2 years ago is complete, or probably complete. Everything's probabilities as of the last weekly bar on the chart. So that's not just a weekly high, that's potentially a multi-month high, of which crude will then be sideways to down for a few months, at least more than 2 months. That's a good possibility. That's what the pattern is telling us. A couple other things to look at. Number one is the timing. Going back to the April 2020 low is 18 weeks up. It was only 9 weeks down, half of the 18 weeks, 19 weeks up, 17 weeks to the next high, 16 weeks to the next high, 19 weeks to the next high. So we've had this 17 or 16, 17 to 19 week reversal cycle. So we were anticipating the last couple weeks also of making a weekly high. So what do we got here? We got like 3 things. We have the weekly momentums have made a weekly bear reversal from the overbought zone. That's a strong signal. A weekly high is complete. We have a textbook of wave 5 of 5, speculative wave 5 of 5 pattern that indicates it's completed the bull trend from the 2020 low. Then we have the time factor. This last week was the maximum time probable to complete a weekly high. We put all that together, and that's a major wake-up call. Just when everyone's in a panic about the higher prices of gas and of oil, we're probably in a position to complete a top that's going to last not just several weeks, but several months. And in the months ahead, very likely that the price of crude is going to be back down. This is a 50 to 62% retracement from around 82 to 70, and that's right in what we call the wave 4 of lesser degree, and that's the typical retracement area for a correction against a 5-wave trend. So we have both price retracement and just a wave pattern guidelines for prices to probably be down 20 to 30%, if not even more than that, over the next several months. So we want to be prepared for that. And let's take a look at the daily data because there's some really good information there also. Well, here's the daily data just coming up from the December low, which you got labeled as a wave 4. And once again, in Elliott Wave terms, a 1, 2, 3, 4, and then this panic buying speculative blow-off top, which happened to unfold beautifully into 5 waves also, 1, 2, 3, 4, 5, into the high that was made on Monday. And then, of course, we've had that really sharp decline. Now, do you know when this happened, the sharp decline? That was when President Biden said we're not going to buy any more oil from Russia. So you would think that oil would start gapping up, not turn around, and have this huge decline in one day. So this is what you call buy the rumor, sell the fact. And that's very typical of the final section of a higher time frame trend. I blow off panic speculative top, and it's just like in a bear trend. Some bear trends end in panic selling. Buy trends or bull trends often end in panic buying. And what's beautiful about this is coming up from the February 18th low. It's subdivided perfectly into 5 waves. This is almost too perfect, in fact. Makes me nervous. But in Thursday then, crude came down and closed below what I got labeled, this little wave 4 of 5 of 5 closing low. That's significant. That's a strong indication that, again, this whole pattern is complete coming up from the February low, and when this section is complete, it should complete the higher time frame section from the December low, which should complete the higher time frame section going all the way back to April. And the daily momentums are bearish, they're not oversold. That indicates probably got another day or two sideways to down before we complete what's called a daily low. Let's go down one more time frame. This is just great instructional material, crude at this time, is that here we have the top last Monday. What should follow the end of a significant bull trend? What kind of pattern on the downside? Well, if the bull trend is complete, the initial pattern on the downside should be what we call impulsive. That's Elliott Wave terms. For an impulsive trend is always a trend in the direction of the higher time frame trend. So this decline should be impulsive. It should be able to be counted when it's finished as a 5-wave impulse decline. So here we are as of Friday. This is a potential 1, 2, 3, and it's a 4. So if early next week, crude makes a new low below this past week's low, that will complete a 5-wave decline. This would be 100.57 down at about 96.68 would be the ideal target for a wave 5 low if this is a 4. But this is all you got to focus on is early next week, crude makes a new low below last week's low. That's an initial strong signal that the higher time frame trend is reversed to bearish. So use that information as you might, as a trader, as a hedger, if you have any interest in oil. And of course, the gas price pretty much follows the oil price. More than likely, the gas prices have also hit a peak just when everybody's in a panic. And eventually, they're not going to come down quickly, needless to say, but eventually they ought to come sideways to down and get back to where they were several weeks ago, if not several months ago. That's crude oil. Great example right now of not only what the probable position is, heavily reliant on Elliott Wave, as well as exactly what it should do next week if indeed the trend is bearish. Because if crude were to immediately advance and not make a new low early next week, then this has a good probability of just being a correction followed by a new high. So that's what we keep up on every day with our DT reports, which reminds me, let me put a plug in before we take a look at the S&P. If you like what you learn in these brief videos we do for YouTube and Twitter, is check out our DT reports at dynamictraders.com. You can also join our DT Traders News for it's no cost. You don't have to give us any information other than your email, so we can send you an alert when we have some updates on our DT Traders News site on our website. So you might as well check it out. You'll get more updates than you get from YouTube, and it might be helpful also for your learning of the kind of trade strategies that we teach and that we use. Okay, let's get back, take a look at the S&P. So this is the SPX weekly data. I'm going to go through this kind of quick. You can get more details really with actually with last week's report. This is a follow-up because this coming week is going to be critical, I believe. So anyway, back to the weekly data. Weekly momentums are oversold, and they're on a bullish divergence with the price low. That's a lower price low, higher momentum low, and it's a strong indication very close to completing a weekly low. Let's go to the daily data. The daily data is telling us an interesting story. This is the closing data for the SPX. I have about 3 different potential wave counts off this top, depending on whether you're looking at closing data or intraday data. What's common with all those, and I went into detail with our subscribers this past week, is that all of them indicate that the market's near a weekly low. Now, we may have a new low next week, and next week is the Fed announcement, and that should finish off this decline if it's not already finished, and it may already be finished. Our daily momentums are at cross purposes. We got the 8 is bullish, 13 is bearish. That just represents a period of minimal to no trend, basically, and that when they both get in alignment with each other, then we'll have probably a pretty strong trend. So what are we looking at? If by chance the SPX makes a new closing low next week, the downside limits will probably be around 41.25, and it would complete a weekly low following the next rotation in the 8 daily momentum, the next cycle and bull reversal. If by chance, before making a new low, the SPX were to close above the March 9th closing high, that was last Wednesday's closing high, 42.7788, that would confirm a weekly low is complete. Now keep in mind that a weekly low is usually followed by, let's just say, a minimum of 2 to 3 weeks sideways to up. But in this case, because the higher time frame trend is probably bearish, and probably going to be bearish into June or later, is that any advance should just be a 2 or 3 week correction within a bear trend. But it'd certainly be a tradable low, but just keep in mind is that more than likely it's just a correction, probably make around the 50-62% retracement, something along that line, maximum up around where the February high is on a closing basis, and then continue the bear trend once that corrective rally is complete. So it should be complete by the end of next week if it's not already complete, and a trade above last Wednesday, or close above last Wednesday's close, will signal that it's complete. Pretty significant week coming up, by the way, in all of the markets, all the financial markets. Well, that's it for today. Have a fantastic week. Keep safe, keep healthy. I'll be back with you next Saturday with another brief tutorial video. Take care.